Chapter 1: The 6 Best Ways to Buy a House with Bad Credit. Welcome back to the channel. If your credit score is low, or you have collections, charge-offs, late payments, or hard inquiries sitting on your credit report, getting approved for a mortgage can feel almost impossible. A lot of people think bad credit means no house. But that is not always true. Mortgage lenders do look at your credit score, but they also look at your income, your debt, your down payment, your job history, your savings, and the type of loan you are applying for. So even if your credit is not perfect, there are still options that may help you buy a home. In this video, I'm going to walk you through 6 different ways to get a mortgage or buy a house with bad credit. For each option, I'll explain how it works, why it can help you, and what problems you need to watch out for. I'll also explain how credit repair can fit into the process, because sometimes the smartest move is not applying right away. Sometimes the smartest move is cleaning up the report first, raising the score, and then applying when your file looks stronger. So without further ado, let's get right into the video. Number 1 is an FHA loan. This is usually one of the best mortgage options for people with bad credit. An FHA loan is backed by the government, which makes the lender feel a little safer approving borrowers who may not have perfect credit. At the time of recording this video, FHA loans can allow a 5% down payment if your credit score is at least 580. And if your score is between 500 and 579, you may still have a chance, but you may need around 10% down. Now listen carefully. Just because FHA allows lower scores does not mean every lender will approve you. Some lenders have their own rules, so one lender may say no, while another lender may still be willing to work with you. That is why shopping around matters. The biggest advantage of an FHA loan is flexibility. If your score is low, but you have steady income, a stable job, and enough money for the down payment and closing costs, this loan can give you a real chance. Another big advantage is that FHA loans are made for people who may not qualify for a normal conventional mortgage. So if you have past credit problems, but your income is stable now, this can be a strong path. But here is the drawback. FHA loans come with mortgage insurance. That means your monthly payment can be higher. Also, the lender will still look at your full credit report. So if you have recent late payments, unpaid collections, charge-offs, or too much credit card debt, those things can still hurt your approval. This is where credit repair matters. Before applying for an FHA loan, you should pull all 3 credit reports: Experian, TransUnion, and Equifax. Look for inaccurate collections, wrong balances, duplicate accounts, old negative items, late payments reporting incorrectly, and hard inquiries that do not belong to you. If something is inaccurate, outdated, duplicated, or cannot be properly verified, you may be able to dispute it. But do not think a dispute letter magically removes real debt. If the item is accurate, updated, verified, and belongs to you, it may stay. The goal is to clean up what should not be there, lower your risk, and make your mortgage file look stronger. So FHA is probably the best overall option for bad credit borrowers who want to buy a house. But you still need income, savings, and a clean enough report to get approved. Number 2 is a VA loan. Now this option is not for everyone. A VA loan is for eligible veterans, active duty service members, and certain surviving spouses. But if you qualify, this can be one of the most powerful mortgage options in the country. Why? Because VA loans can offer no down payment. They also do not require private mortgage insurance. That alone can make a huge difference. With most loans, if you do not put enough money down, you have to pay mortgage insurance every month. But with a VA loan, that is not required. This can help keep the monthly payment lower. Another big advantage is that VA loans can be more flexible than conventional loans. The VA itself does not work the same way as a normal lender, but the lender still has to approve your credit, income, and overall file. So even if there is no strict VA minimum credit score from the government side, many lenders still set their own credit score requirements. That means if one lender denies you, another lender may still have a different rule. This is very important. Do not stop after one no. The biggest benefit of a VA loan is that it can help someone buy a house without needing a huge down payment. So if your biggest problem is cash and not income, this can help. But there are drawbacks. You must be eligible. You may have to pay a VA funding fee, and the lender will still care about your payment history. If you have recent late payments, open collections, or high debt, the lender may ask questions. They may want explanation letters. They may want to see that the problem is fixed. They may want to see that your current payments are on time. So if you are eligible for a VA loan, your first step should be getting your certificate of eligibility. After that, you should review your credit report before applying. If there are inaccurate negative items, work on them first, because even with a strong VA benefit, a messy credit report can still slow down the approval. Number 3 is a USTA loan. This is another powerful option, but it depends on where you want to buy. USDA loans are made for eligible rural and some suburban areas. A lot of people hear the word rural and think it means the middle of nowhere, but that is not always true. Some areas outside major cities can qualify. The biggest advantage of a USDA loan is that it can offer no down payment for eligible buyers. That is a huge benefit for someone who has income but does not have a lot of savings. This can help people who want a home but are struggling to save 10%, 15%, or 20% down. USDA loans can also have competitive terms because they are backed by the government. But there are important limits. The home has to be in an eligible area, your income has to fit the program limits, and the home has to be your primary residence. This is not for investment properties. Now, when it comes to bad credit, USDA can be tricky. Many lenders like to see a stronger score, often around the low to mid 600s, because that makes the approval easier. If your score is lower, you may need manual underwriting. That means the lender has to look deeper into your file instead of getting a simple automated approval. And manual underwriting is not easy. They may look at rent history, payment history, debt to income ratio, savings, job stability, and why your credit score is low. So if you want a USDA loan with bad credit, you need to make your file look clean. That means you should not have recent late payments. You should not have maxed out credit cards. You should not be applying for random new credit. And if there are collections or charge-offs reporting wrong, you should work on them before applying. USDA is best for people who qualify by location and income, have stable employment, and need a low or no down payment option. But if your report is full of recent negative items, you may need to repair the credit first before this option makes sense. Number 4 is a conventional loan. Now, this is not always the first choice for someone with bad credit. A conventional loan is not backed by the government like FA, VA, or USTA. Because of that, lenders usually want a stronger borrower. In many cases, conventional loans usually need at least around a 620 credit score. But here is where this gets interesting. If your score is not extremely low, and you are close to 620 or already above 620, a conventional loan may be worth comparing against FA. Why? Because mortgage insurance on a conventional loan can usually be removed later when you have enough equity. With FA, mortgage insurance can be more difficult to remove depending on the loan terms. So even though FA is easier to qualify for, conventional can sometimes be cheaper long term, but only if your credit score, debt, and income are strong enough. The advantage of a conventional loan is that it can be a cleaner long-term option. You may have lower mortgage insurance later. You may have more property flexibility. And if your credit improves, you may get better pricing. But the drawback is that conventional loans are stricter. If your score is barely qualifying, your rate may be higher. Your mortgage insurance may be higher. And if your debt to income ratio is too high, you may be denied. This is where the credit repair strategy becomes very important. If your score is 590, 600, or 610, you may be very close to a better loan option. Removing inaccurate negative items, Paying down high credit card balances, fixing reporting errors, and getting your utilization lower could push your score into a better approval range. Sometimes people do not need a miracle. They just need 20, 30, or 40 points. And those points can change the whole mortgage conversation. So conventional loans are not the best option for very bad credit. But if your score is close to 620 or higher, this may be worth looking at before jumping straight into FA. Number 5 is a non-QM or portfolio loan. This is a different type of mortgage. Non-QM means non-qualified mortgage. Portfolio loans are loans that some banks or lenders keep in-house instead of selling them the normal way. These loans can sometimes help people who do not fit the regular mortgage box. For example, self-employed borrowers, business owners, people with bank statement income, people with strong cash flow but messy tax returns, or people who have credit problems but also have a larger down payment. The advantage here is flexibility. A normal lender may say, "We cannot approve this file," but a portfolio lender may say, "Let's look at the full situation." They may look at bank statements, assets, rental income, reserves, business income, or other proof that you can afford the home. This can be helpful if your credit is not perfect, but your income is strong. But here is the warning. These loans can be more expensive. The interest rate may be higher, the down payment may be higher, the fees may be higher, and the lender may ask for more reserves. So this is not the first option I would run to. This is more of a backup plan. If FA, VA, USTA, or conventional does not work, then you can look at non-QM or portfolio lenders. But do not accept a bad loan just because you are desperate to buy a house. A bad mortgage can trap you. You want a house that builds wealth, not a payment that destroys your budget. So if you go this route, compare offers carefully. Look at the interest rate. Look at the APR. Look at the fees. Look at prepayment penalties. Look at the total monthly payment, and make sure you actually understand what you are signing. Number 6 is the credit-first mortgage strategy. This is not a loan. This is the process you use before applying for the loan. And for many people with bad credit, this may be the smartest option, because sometimes the problem is not that you cannot buy a house. The problem is that you are applying too early. Your report is not ready. Your score is too low. Your credit card balances are too high. Your collections are still reporting. Your late payments are still hurting your profile. Your hard inquiries are making the report look risky. So instead of applying and getting denied, you fix the file first. Here is how the process works. Step 1. Pull all 3 credit reports. Not just Credit Karma. Not just one bureau. You need Experian, TransUnion, and Equifax. Mortgage lenders usually look at all 3, and they often use your middle mortgage score. So if one bureau looks clean, but the other 2 look bad, that can still hurt you. Step 2. Find the negative items. Look for collections, charge-offs, late payments, repossessions, bankruptcies, hard inquiries, wrong personal information, duplicate accounts, and wrong balances. Step 3. Separate what is accurate from what is questionable. If something is accurate, current, verified, and belongs to you, it may not be removed. But if something is inaccurate, outdated, duplicated, unverifiable, or reporting wrong, then it may be worth disputing. Step 4. Lower your credit card utilization. This is one of the fastest areas that can change your score. If your cards are maxed out, lenders see risk. Even if you pay on time, high balances can hurt you. So before applying for a mortgage, try to get those balances down. Step 5. Stop applying for new credit. Do not finance a car. Do not open random credit cards. Do not apply for personal loans. Do not create new hard inquiries right before a mortgage. Mortgage lenders want stability. They do not want to see you taking on new debt right before buying a house. Step 6. Talk to a mortgage lender before making big moves. This is very important. Sometimes paying a collection the wrong way can update the account and create problems. Sometimes open disputes can create issues during underwriting. Sometimes the lender may want a certain item handled in a specific way. So do not guess. Get your report reviewed. Create the plan. Then apply when your file is stronger. This credit-first strategy is best for someone who is close to qualifying. Maybe your score is 540 and you need 580. Maybe your score is 600 and you need 620. Maybe your income is good, but your report has too many negative items. This is where credit repair, balance paydowns, and smart mortgage planning can make a big difference. Now that we covered all 6 options, let's compare them. If your credit score is very low, FA may be the best starting point. If you are eligible for military benefits, VA may be the strongest option because of the no down payment and no monthly mortgage insurance. If you are buying in an eligible rural or suburban area, and your income fits the limits, USDA can be powerful because it may allow no down payment. If your score is around 620 or higher, conventional may be worth comparing because it can sometimes be better long term. If you are self-employed, have strong income, or do not fit normal lending rules, a non-QM or portfolio loan may be an option. And if your credit report is messy, but you are close to qualifying, the credit-first strategy may be the best move before applying. Now let's talk about the biggest mistake people make. They apply too early. They see a house they like. They get excited. They apply for a mortgage. Then they get denied. And now they have a hard inquiry, disappointment, and no clear plan. Do not do that. Before you apply, know your numbers. Know your credit score. Know what is on your report. Know your debt-to-income ratio. Know how much money you have saved. Know which loan program fits your situation. And know what needs to be fixed first. Because bad credit does not always mean no mortgage. But bad planning can definitely lead to a denial. So which one is best for you? If your score is between 500 and 579, you may need to focus on FA or credit repair first. If your score is 580 or higher, FA becomes a stronger option. If you are eligible for VA, check that before anything else. If you want no down payment and the property qualifies, look into USTA. If your score is 620 or higher, compare FA and conventional side by side. And if you are self-employed or have unusual income, ask about portfolio or non-QM loans. But be careful with the cost. The smartest move is not just getting approved. The smartest move is getting approved without overpaying for the house, the loan, and the interest. Because the goal is not just to buy a house. The goal is to buy a house and keep it. So before you apply, clean the report, lower your balances, save your down payment, avoid new debt, and compare multiple lenders. If you got value from this video, like and subscribe. And if you want me to make a full step-by-step video on how to clean your credit before applying for a mortgage, drop mortgage in the comments below. I'll see you in the next video.